accurately based on, for instance, historical data, and there's a lot of things to say about that, and we will say something later in this class. Alright, so this can be produced in this particular way, or we can say something like take this vector, which is a k by 1 vector, transpose it, and multiply it by the vector of weights, which is a k by 1 vector. And that produces the same operation. The expected return of the portfolio you are building can be expressed in this way, but it can be also more conveniently expressed, more simple, but more convenient when we deal with computers involving HSI. We did that last week. The expected return of the portfolio is constructed by taking this operation, right? You need to transpose one of the two vectors and make the conformable operation. And then the variance of the portfolio, would be a weighted sum of all the individual variances and cross-covariances. That's a little bit more complicated to write, but it's very simple to do this operation in terms of matrix algebra. Once again, we get the transpose of the vector. This is a 1 by k vector. When we transpose it in this way, we multiply the covariance matrix, which is k by k. We see how these dimensions agree, and then we post-multiply by the vector covariance. So this is a k by 1 vector. Once again, there is agreement in dimensions, and what we end up with is this 1 by 1, a scalar having the variance. So we deal with volatility. So the volatility of the portfolio is the square root of that. What happens is everything can be characterized in terms of these two inputs. So all the portfolio that you may randomly assign will fall in this plane, expected return versus volatility of the portfolio, and most of those portfolios are being dominated by what we call the efficient portfolios. Everything that lies below that curve is inefficient, is suboptimal, is not a priori a rational investment that you may like to be on. For this portfolio here, we get a combination of return and volatility, and what happens is that there is another portfolio which matches the level of volatility, but it has a better expected return. So clearly this portfolio is better than that portfolio there. The same thing, we go around this dimension. For this portfolio here, we have this level of expected return. All these portfolios along this line have exactly the same level of expected return, but for that particular one, having this level of volatility, this portfolio here in the level, in the envelope of this set is efficient because it has the minimum volatility given that level of expected return. So this is what we want to go in terms of optimality. You fix one of the dimensions, volatility of expected return, and you want to go optimal in the other. And going optimal in volatility means minimizing volatility. Being optimal in terms of expected return means maximizing expected return. This is what a rational investor characterized by mean variance preferences would do in this context. Okay? Now, these two portfolios are efficient. Which one is better?
Depends on the investor.
Depends on investors. All investors will agree that this is the best combination possible of portfolios. This is the global minimum variance portfolio, the portfolio that will have the smallest variance possible. And then essentially investors will pick up the portfolio that matches their preferences. So someone having preferences like this will be okay with this portfolio, and that will be the perfect portfolio for that person. But someone having preferences which are more tolerant to risk will demand a greater expected return because he will be okay being exposed to greater volatility. So this person A and this person B have different preferences, both characterized for the same family of mean variance problem, right? But investor A will be happy choosing this portfolio, whereas investor B will be happy choosing that portfolio. All right? So there are three, yeah.
So we always talk about like relation to portfolios, right?
Yes, portfolio, all of portfolios. Even individual assets can be an individual asset can be considered a portfolio. That's having 100% on let's say omega 1 is 100%, everything else is 0. So even individual assets can be seen as a portfolio in this context. So individual assets will be, with in all probability, suboptimal. If you say, where are those individual assets? Somewhere in the suboptimal area. It's very, very unlikely that individual asset can be an efficient portfolio. Because it's a better combination when you sort of, articulate the others that produces the same expected return. And we will see that, particularly when short selling is allowed. If you don't allow short selling, typically what happens is that the most extreme assets, something like the one having the extremest return, that's probably efficient because you need to go up there, and that's probably means investing in that particular asset class. But if you allow for short selling, then you can replicate that with the other portfolios, with the other assets, and even that extreme asset will be an inefficient. There are three optimization problems here to be considered. Last week we solved the first one. We said the problem in terms of maximizing. So we solved omega, we were looking for the optimal value such that we wanted to minimize the volatility of the portfolio, and the volatility of the portfolio we have said that it's a function, it's a square root of a quadratic form involving the weights, right? So you can play, by changing those omegas, you change the volatility of the portfolio. Subject to two constraints. We said that we want a certain return. What's the other way around? The one that we did. We maximize the expected return of the portfolio. That's what we did last week. We started maximizing the expected return of the portfolio, which clearly is a function of the omegas, subject to the constraint that the volatility of the portfolio is to be equal to a certain level. So we are sort of fixing this level, for instance. I want to have this level of volatility. All these portfolios will be eligible, but the optimal one is this one, the one that maximizes the expected return. And we identify that thing with another condition, which is that the sum of weights needs to be equal to 2. In other problems, you may like to impose further constraints, and in Excel that can be done very easy. You may tell me, but for instance, I don't want the weight in the second asset to be smaller than 20%. I want to put at least 20% of my portfolio on asset number 2. Then if we really write this problem in these terms. Or just the other way around. I would like the, let's say, asset number 3 not to have more than 10% of my budget.
I have a question because I've seen if you have like 30 assets in your portfolio that you believe in good, no asset can go beyond 10% of portfolio weight or whatever. So how do, but I think we are like biasing in some way the optimization problem if we put on many restrictions.
Yeah, well, it's another thing. Then we go with theoretically, that's a thing, and then it's what happens in reality. And it's the bigger the dimension, the more complicated the optimization problem, the numerical optimization problem, and the more restrictions you put, the harder this objective function to be optimized is going to be. And there are now, and there's a number of things that happen. Actually, even with a small dimension, there are certain characteristics that appear. Like, for instance, you will see that many often assets take 0 power, or you don't put anything in an asset. It's kind of weird thing. You should invest in a parallel. This is what happens in this context. That's why sometimes you like to have not at least, I want to invest at least a certain amount. But the problem is that Excel is not going to be the best tool when you deal with very complicated problems, having a portfolio with 30 assets and 30 restrictions. Excel is sort of working Excel to the box. Okay? It becomes very, but for a small problem like this, like we are here, Excel is okay.
So the last class, the last exercise, so we maximize return based on the optimal distribution with the constraint.
No distribution here.
So we, like, remember we have the bonds, the percentage of the bonds, the cover box, this box. So those changes based on whatever you want the mean to be, right? Whatever the maximum would be. So when we do this over,
So
we set the volatility to 10%,
right.
and then that will maximize our mean.
The expected return on the portfolio, so it's like we have two inputs here. You fix one dimension, that's the way we tackle the problem. You fix one dimension, and then you go optimal in the other. So it's like, for instance, here we are fixing the volatility. Among all the levels of volatility, this constraint tells the problem about to be here in this line. And of course, there are multiple portfolios there. All these portfolios are candidates, or all of them are eligible. But only one is the one that you want to pick. Only one is the optimal portfolio. That one is the one that maximizes better return. So this is a combined problem that allows you to identify that factor. And then we always put the bind constraint. This one needs to be always there. Okay? This is what we did last week, and we identified one portfolio having volatility 10%, right? That was the one that we sort of started with. And the weights are like at 40.9% on treasury bills, 15% on corporate bonds, 43% in stocks. And you see that all these conditions are satisfied. The sum of the three weights equals 100. Then the volatility portfolio is 10%, so these conditions are satisfied. And what we get is the maximized expected return at 4.48%. There is no way in which you may combine these different portfolios that will give you more expected return than that one. If we go to the solver problem, our problem is programmed there, right? We can still play with this thing and solve a number and address a number of questions. For instance, is the equally weighted portfolio an efficient portfolio?
No.
How do you know it?
Well, I don't think so.
You don't think so, okay? That's better. This is going to be very unlikely to fulfill this perfect condition. So how can we figure out whether the equally weighted portfolio is a portfolio that puts the same weight on it in every asset? So let's say 1/3, 1/3, 1/3. How can we figure out if the equally weighted portfolio is efficient?
We have to move up. We have to make a restriction that every weight is the one over the number of assets.
But then you have a portfolio. How do you know if it does efficient or not?
You take the variance on the mean and you see the little dot if it's in the front here.
How can we do this operationally? It's very close. The source is super there. So two steps. First of all, we're gonna see what the mean variance of the equally portfolio is. So I'm gonna save this efficient portfolio, right? I'm gonna take the mean variance, this stuff here, I don't need anymore. I'm gonna leave these cells here, where we have the program, the macro in Excel, the solver is calling those cells. So I'm not gonna I'm gonna sort of play all the time with this particular range. And I'm gonna save these portfolios, copy pasting here, right? I'm gonna put it there. I'm gonna collect my efficient portfolios, right? So that's, if you like it, that's gonna be efficient portfolio number one. We get just one efficient portfolio. Now, let's check the second condition. I go for the equally weighted portfolio. So we run a portfolio that we place 1/3, right? And that's okay. So 100, because we are working in percentages, 100/3. That gives us the 33% that we are looking for. I copy paste. Now the condition is satisfied. This is the equally weighted portfolio. The equally weighted portfolio has a volatility of 8.94 and expected return of 3.9. Now, how can we know if this is an efficient portfolio? Right, so I'm gonna copy this. This is the equally weighted portfolio, and I'm gonna simply copy paste these values. Right? For this particular, we can identify the portfolios with the weights. That particular composition has associated these levels of volatility and mean, but we don't know. We don't formally know if this is efficient. Vivian, how can we determine the question?
Maybe we can value, we can compute, like we set the variance of this one and we calculate out his return and we compare the returns of them.
Exactly. We need to check the condition. We need to find if we are able to find, we need to see if we are able to find another portfolio having volatility 8.94, and because we are gonna solve the problem, this is gonna be the efficient portfolio. If the equally weighted portfolio is efficient, we will not find other portfolio with greater expected return. So this is the only way to match. You know the volatility of this, you know the identifiers of this portfolio. Check it out. So I'm gonna target, the target for volatility is gonna be the volatility of the equally weighted portfolio. So I make a reference to this level, 8.94, right? That's our target. I'm gonna give it a couple of decimals. And then, because we have in the solver, in data solver, we have stored the problem that maximizes by expected return, by checking the conditions that the sum of weights equals 1 and the volatility equals our target. Now we solve for this problem. And the nice thing of Excel is that once you program the solver, it is stored in the terms that you did it. So by changing the target, I can recycle, so to speak, what we did last week. I can take advantage of that. The problem is that we can only have one thing stored. If we change the program, we will have to change this program to the other version of the problem, right? We would like to think more. This maximizing expected return, even volatility, is not the most natural option for us. We started this way, but it's not the most natural way of thinking. The most natural way of thinking for us is, I want this expected return. So we will have to change that, and once we do that, we will lose this problem. So taking advantage of this already programmed in our contest, we have a volatility, the one that produces the 8.94 volatility has a expected return which is slightly bigger, with 3.99, and is not the equally weighted portfolio. So this is the efficient portfolio that has exactly the same, right, which is mimicking the equally weighted portfolio. This one is having exactly the same level of volatility, but greater expected return. And actually, because that comes from the optimization problem, we know that we cannot improve. Now, this is the efficient portfolio, and hence the equally weighted portfolio is suboptimal. This is something that happens very often. People invest in an equally weighted portfolio, something like that, like a kind of sort of round thumb approach. I go there in a kind of rough way. Okay, that's typically a suboptimal investment. Questions, guys?
So we always, whenever we try to analyze, we maximize that portfolio to whatever we want. So let's say we don't have a half zero, then we will do the same process, right?
We don't have that.
Let's say we have different weights, like we wanna evaluate 50%, 50% zero, we will do the same thing, right?
Yeah. You choose arbitrarily a portfolio, but typically it's gonna be sub-efficient. Typical. So for instance, if you want to check, you know that the the investment in the stock has a volatility of 20.81%, 9% expected return. The question will be, is this efficient? We solve the problem in exactly the same terms. Alright, I'm gonna target the volatility, right? I'm gonna target my level of volatility to the volatility of the stock. So to that 20.81%. So that's a very extreme portfolio. This one is produced with 100% stocks, zero elsewhere. I wonder if this is a efficient investment. So the only way to solve the problem is, as we mentioned before, we need to check the conditions. So once again, we go to the solver, we have this, the computer, right? We have this as a calculator, and now we solve again, and we are okay. Now, for this extreme portfolio, if short selling was not allowed, it's very unlikely that we can find something more efficient. A very high portfolio like that one, without the opportunity to short sell, is probably the efficient portfolio. You can only, without short selling, you only can reproduce in this space, you can get that far, only you put 100% on stocks. But if you are allowed to short selling, then you can get something that has the same level of volatility, 20.81%, but yields a slightly greater return, 9.19%. And to do so, you need to take a lot of investment, a lot of stake on stocks. Of course, that's natural. I need to produce there. I'm essentially trying to replicate in this payoff. But at the same time, we don't go 100% there anymore. We do this kind of combined positions in which you sort of finance and something on corporate bonds, and then you need to finance that with the treasury bills. And essentially what we are doing is exploiting the structures of the correlations. Because correlations are non-zero, by taking short selling, we can sort of exploit these things, making something like a hedging. We are sort of taking a little bit more of risk, and at the same time hedging that with the treasury bonds, and that produces the same expected volatility with a greater expected return. Short selling is associated with speculators, but it has a critically important function in the stock market. It provides liquidity. These guys exploit the short selling, and by doing so, they are able to yield portfolios which are better and construct arbitrage opportunities and exploit arbitrage opportunities and make the market more liquid. So people say, short selling should be banned because it's a kind of intrinsically evil thing. And that happened, for instance, during the financial crisis. Everyone was trying to short sell, and that was putting a lot of pressure down on prices. And then the US government says, okay, stop, enough. I'm gonna get this, we're gonna switch off this thing. Short selling is not permitted anymore. And then all the investment banks and all these guys that can do short selling, complain a lot. You know what you are doing, you are sort of, you are mutilating the market because you are sort of preventing us from providing these opportunities which otherwise we are not interested. So it's not just an evil thing, it's just a mechanism, another part of the trading in the stock market. Guys, questions? So we have 3 portfolios. This one is export.
Antonio, can you read out again the third one?
The last one?
Yeah, the one that indicated the equally weighted, but it's not happening.
We are doing it's always the same thing. We constructed the equally weighted portfolio, right? And this is something that we do manually.
Yes,
One,
it's 1/3.
Okay.
And that's-
right?
yeah,
And that gives us expected return, which is whatever it comes from this operation, and the volatility that comes from that. But now, if you don't solve the tuition problem, the more likely scenario is that this portfolio is suboptimal. And that was the massive point of Markovich. If you don't use appropriate volatility techniques in the market, the most natural thing is going to happen to you, you go suboptimal to the market. So the way to check that consideration is to go into the outputs of the portfolio. You get 3.90% expected return, 8.94 volatility. So in order to check if this portfolio is efficient, we need to solve the problem in the way we are doing. Right now in this program, in terms of volatility, all right, let's find the composition of the portfolio that matches that 8.94%. So it's like the equally weighted portfolio will be around here. It's not very far away from the optimal portfolio, but it's dominating, and that's the point. If I want to take 8.94%, what I should be okay with 3.9 when I should get 3.99. I will go for the composition that give us the 3.91%. And the same thing happens with this portfolio here. This one is replicating the payoff. This one attempts to replicate the volatility of the 100% investment on stocks. And what happens is that by exploiting the possibility of short selling, and we see short selling there, right? That's the short position. By taking a short position on treasury bonds, we get extra funding and we can finance the investment of stocks, that's okay, but a lot of extra investment on corporate bonds. An important thing here is that by doing this particular recipe, we are playing with the covariances. We're exploiting that correlation structure. And that allows us to get something that has the same level of volatility as meant, the 28.81%, but it produces something more profitable, 9.19 versus 9% that the 100% investment stock is. So this investment is the optimum.
And you think that that's for the portfolio? Like, why is the volatility only 1?
What is the what?
Why do we think the volatility is 20?
Because we are solving for volatility. Our solver was programmed in this particular way. So that's what we're gonna do because you feel you don't like that, Jesus, don't worry, we're gonna change it. Now we are gonna move after playing with these 4 portfolios, we go into the other individual problem. The problem with Excel is that we cannot store, we cannot have multiple solver. Maybe it's gonna be fixed in some, forward future update. But up to the moment, we can only have one problem stored in the solver map. So once we go into the other setting, we will override this one. But before jumping, I want to make sure that everything is understood here, right? So we are sort of checking for portfolios, and when you ask me if a portfolio is efficient, there is only one way in which I can reply to that question, and it's checking if the parameters of this volatility or that expected return match one of the efficient frontier. Alright, so that's another efficient portfolio. So I'm gonna call it efficient portfolio number, well, we have 2 efficient portfolio number 3. Okay, so we said that's one possibility of exceeding the problem. But that's not the only possibility. The only possibility, which is more natural for us, that will be optimization problem number 2, if you like, or optimization problem B, is we have our level of volatility, we have our expected return, plus the efficient frontier. Now, it is much more natural for us, the idea of volatility, because we don't observe volatility, we are not so familiar to that dimension. It is much more natural for us to think in terms of expected return. So you would like to get an expected return. So let's say, Jose Daniel, one expected return you may like to get in this portfolio.
20%.
How much?
20.
It's infeasible. You will not be able to get that 20% unless you get a kind of massive investment in short selling, and probably 20% is not feasible.
So 5.
That's why plotting the investment set makes sense. We can sort of figure out how much the things that we can get out of these 3 assets. So something between 2% to 9% is attainable. 20% is way above what these poor assets can get. So how much do you get? 5%. This is the most natural thing for us to think. I want a 5% portfolio. So we need to restate the problem in those terms. So we are gonna fix one dimension. I want this 5%. So all of those portfolios around the 5% line are tenable are candidates, but the optimal portfolio, when compared two portfolios, is the one that minimizes volatility. So we need to state the problem in terms of, I want the composition of a portfolio that minimizes the volatility of the portfolio, which is a function of the weight as well, and then subject to two constraints. One is the target. So this is the one that's identifying the line, right? The dimension at which we want to move. So the expected return on the portfolio needs to match this value. And then is, of course, the budget constraint, which is always a mandatory. Whatever it happens, this will be always there. The sum of weights needs to be equal to. So to do that, and as safe, not to lose our changes, and then now we need to change the Excel solver problem. I give you 5 minutes, and I want the composition for Jose Daniel portfolio. 5%. How we can get that for him? 5 minutes, and I solve it.